Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome to this Peak Prosperity podcast. I am your host, of course, Chris Martenson. How do we make sense of the world's financial markets? Professionals all across the spectrum of investments and investing are increasingly turning sour on the markets that the central banks have created, and sometimes are even revolted by what they see. Not everyone yet, but the chorus is growing. Something is wrong with the markets. What's wrong can be summed up in one word, I think: speculation. As today's guest is going to put it, he put it so well recently, the entire global financial system has been turned into a massive speculative carry trade. And if you think that fundamentals no longer matter and that central banks can control every wiggle and tune every economic dial to their heart's content, then you probably shouldn't listen to this podcast at all, because it's going to be a waste of your time. But if you know that prosperity cannot be printed out of thin air and that reversion to the mean is an important concept, you're going to love this podcast. Today we're going to talk with one of my favorite people in the world, a great guitar player and a true gentleman and a friend, John Hussman, the principal at Hussman Funds. John, hey, it's a real treat to have you on the program today.
Hey, it's likewise. I love talking to you.
Thanks. Well, I can't think of any better place to start to describe today's massively distorted financial environment than with the Bank of Japan's recent move, which we're calling Kuroda's Halloween Massacre, mainly because that sounds spooky. But what did you take from that event in terms of what it tells us about the mindset of the Bank of Japan and where we are in this narrative of central bank-inspired reflation, I guess I'll call it?
Yeah, there are actually two pieces to that. One is that it really smacks of desperation in some sense, because, the Bank of Japan has been doing this for quite some time. The Federal Reserve has made equivalent efforts. And really the idea behind quantitative easing is that, if you create enough idle bank reserves, you will somehow trigger spending. The way quantitative easing basically works is the central bank buys bonds that have been issued and that are held by the public, and it goes out and buys those bonds and creates bank reserves and currency instead. Bank reserves and currency are what we call the monetary base. And the basic idea is that you make people uncomfortable holding zero interest money. If you've got cash in your pocket that's not earning anything, and you've got bank reserves that essentially aren't being paid anything. In the U.S., it's about 0.25% that the Fed pays on idle reserves, but it's essentially nothing. If people are holding these very low interest assets, they reach for yield. And the whole mechanism behind quantitative easing, the whole economic argument for quantitative easing, is that by holding interest rates low, you will either stimulate interest-sensitive demand, housing and that sort of thing. But at this point, we really don't see that. And then the only other mechanism by which it could work is if people become so uncomfortable with zero interest rates that they feel forced to reach for yield in more speculative vehicles. Now, the Federal Reserve, Bernanke particularly, believed that if you made people speculate enough and they drove prices up enough that they'd feel wealthier and go out and spend, that actually contradicts what economists have known for decades and what Milton Friedman won a Nobel Prize largely for demonstrating, which is that people don't consume off of speculative sources of income. They don't consume off of volatile asset prices. They consume off of what they believe their long-term permanent income is, and their view of their long-term earnings power and so forth. And so what we've seen in reality is very little effect from quantitative easing, but they keep on pushing this accelerator because it's all they know. It's kind of like, if you give, somebody a hammer, everything looks like a nail. With these central banks, if you give them a tool like quantitative easing and they're allowed to do it and the public somehow maintains a hope that it'll have some effect. They've kept on doing it for some time. We're not seeing the effects. We are seeing enormous speculation, though, because when you've got interest rates at zero, people sometimes feel forced to take risk. And if they feel forced to take risk, they'll start doing it. And what we've seen is they've done it without reference to value. And right now we've got some enormous valuation gaps in the market that will be closed over time.
Well, let's talk about those enormous valuation gaps. Let's start with equities, because that's the headline show that people are watching and paying attention to. Now, October starts, equities have just a tiny bit of a stumble. They're down 6, maybe 7%, depending on the index we're talking about. And the Fed trots out Bullard, who immediately says, hey, careful here, people. We're gonna keep interest rates low forever. We're gonna throw more QE into this if we have to. So I took that as a sign that even slight weakness can't be tolerated in this market. Is that because, do you think, that the Fed officials know they've created a speculative monster and they need it to keep going?
Well, I actually think that Bullard was acting out of sync with the rest of the FOMC. I think there's less tolerance, except for perhaps Cottrell-Cota, to do more QE. I think the general view, at least at the Yellen Fed, is that there hasn't been a great deal of benefit from that, and I do think that they're serious about moving the other way. I think it's going to be a much higher bar to getting more quantitative easing, even in the event that we get normal cyclical weakness in the economy. What I think happened with, certainly Bullard has been, on the dovish side of QE, but I think what's going on is that there is an increasing recognition that assets are at a speculative level. They wouldn't admit that outright, except for Richard Fisher, who's been very, outspoken about it. But I think broadly speaking, the view at the Fed is that they would like to get to a normalization of policy over time, and that tweaking this with another round of QE isn't likely to do a whole lot for the real economy.
Now, what are your views on the impact of QE on the equity markets, though?
All right. So what's interesting here is that, if you think about equities, they're not a claim on next year's earnings. They're not a claim on next year's, prediction of earnings by Wall Street analysts. A stock, in fact, any security, is a claim on a very long-term stream of cash flows that investors can expect to be delivered to them over a very long period of time. So when you look at equities, you can calculate something called duration. It's essentially the effective life of a security over which you're collecting, cash flows in return for the amount you pay. And for the S&P 500, the duration's about 50 years. In other words, it's a very, very long-term asset. The only reason you would want to price that asset based on your estimate of next year's earnings is if you were convinced that next year's earnings are actually representative of the very, very long-term stream, and I'm talking 50 years or so, of earnings that you're likely to get. In other words, that those earnings are, in a sense, accurately proportional to the whole long-term stream. But what's amazing about that is that it's never been true. It's never been true historically. If you look at corporate profits, and especially corporate profit margins, they are one of the most cyclical and mean-reverting series in economics. Right now, we've got corporate profits that are close to about 11% of GDP. But if you look at that series, you'll find that corporate profits as a share of GDP have always dropped back to about 5.5% or below in every single economic cycle, including recent decades, including not only the financial crisis, but 2000, 2002, and every other economic cycle we've been in. And so right now, stocks as a multiple of next year's expected earnings may look only modestly overvalued or modestly richly valued. But really, if you look at the measures of valuation that are most correlated to the returns that stocks deliver over time, say over 7 years or over the next 10 years, the S&P 500, in our estimation, is about double the level of valuation that would give investors a normal rate of return. So right now we've got stocks valued at a point where we estimate the 10-year prospective return on the S&P 500 will be about 1.6 to 1.7% annualized. And we're talking right now with the S&P 500 at 2032 as of today's close.
Well, I guess, 1.6 or 7% doesn't sound bad if you're getting zero on your risk-free money, I guess. But this says that any move by the Fed to normalize, which means rates have to go up, any move to drain liquidity from the system is going to have its own impact. So if we held all things equal, a normalization effort is going to then basically expose that the stock market is roughly overvalued by 100%.
100%. Yeah, I actually think the case is even a little harsher than that. In fact, quite a bit harsher than that, because the idea that 1.7% isn't so bad or 1.6% isn't so bad ignores the fact that really in every market cycle and economic cycle we have had a point where stocks were fairly valued or undervalued. The only cycle that we didn't see that was actually the 2002 low, where stocks actually ended that decline, at an overvalued level on a historical basis. Now, we still ended up being able to reduce our hedges by about 70%, after that bear market. And get much more constructive. But the valuations were still relatively high on a historical basis in 2002. They got slightly undervalued in 2009, but not deeply. On a historical basis, what's interesting is that if you look at measures of valuation that correct for the level of profit margins, you actually get about a 90% correlation with subsequent 10-year returns. And that relationship has held up even over the past several decades. It's held up even over the past 5 years, where the expected return that you would have forecast based on time-tested valuations turned out to be pretty close to what you would have forecast 10 years earlier. So right now, like I say, we're looking at stocks that have been pressed to long-term expected returns that are really dismal, but more importantly than that, in every market cycle that we've seen, with, like I say, the mild exception of 2002, we've seen stocks price back to normal rates of return. And at that point, in order to get to that point, we would have to have equities drop by about half.
Half. Well, some people are saying that because, for instance, Bank of Japan and I think the U.S. Fed is in the same quandary. They can't really allow rates to rise because then the interest expense for government debt would consume entirely whatever tax receipts they've got after a certain point. For Japan, that's a very low point. It's somewhere between 2 and 3%, depending on which analysis you like. But looking at that, there's an argument to be made that the central banks can't ever allow rates to go back to normal. I mean, the long-term historical norm in Japan was closer to 6%. Now it's a blended rate of just under 2%, 1.5%, somewhere around there. And if it gets to 2%, it sort of like lights out from a mathematical debt cycle behavior sort of a standpoint. What do you say to that? It is, are the central banks really trapped and they can't allow rates to rise, or do you think the markets have a mind of their own and rates will rise if they need to?
So essentially, I'd like to suggest that the amount of risk that we see in the equity market does not predicate on whether the Federal Reserve or the Bank of Japan raises rates at all. Okay. One of the things that's interesting is if you look at say, the federal funds rate during the 2000-2002 decline and during the 2007-2009 decline. Both were stocks dropped half of their value. The NASDAQ during 2000-2002 dropped more than three-quarters of its value. In 2007-2009, the S&P dropped about 55% of its value. If you look at what interest rates were doing, what the Federal Reserve was doing there during that period, it was easing aggressively. It was cutting interest rates frantically during both of those declines. And so the idea that interest rates have to go up in order to trigger a down move really doesn't get as much support in the historical data as people often suggest. What actually happens, the most hostile way that hostile condition that you can approach in the market is one where stocks have been in a very overvalued, overbought, overbullish condition for possibly several years, and then you start seeing a breakdown in market internals. And by market internals, I mean breadth, I mean leadership, I mean advanced decline, various indices failing to confirm highs and so forth. Because what's actually happening is when people are taking risk, and they're very eager to take risk, you'll see them take risk in everything. You'll see what we sometimes call trend uniformity. You'll see not only stocks going up, high-quality stocks, low-quality stocks, junk bonds, advanced decline, small stocks, large stocks, utilities, transports, foreign stocks. In other words, when people are willing to take risk, they're just out there throwing the dice on everything, and you can read that preference out of the uniformity or lack thereof of market action. When you start seeing the following sequence, a very overvalued, overbought, overbullish, extremely lopsided optimism about the market, extreme valuations, and then you start seeing a breakdown in market internals, which is actually what we started to see several weeks back, and we still have not recovered in terms of internal action. Then you're seeing a situation where there's an increased preference to avoid risk. And where investors are becoming more risk averse, they're backing away. And in that environment, when you have very, very low, thin risk premiums and people are backing away from risk, it doesn't matter that there's a lot of zero interest rate money out there, because zero interest rate money in a risk averse environment is desirable. And what quantitative easing really relies on and has relied on is the view of safe low interest rate money as kind of the pariah of the investment world, as an undesirable asset, as an inferior asset. When risk aversion starts rising, that's no longer true. And so the Federal Reserve during 2000, 2002, during 2007, 2009, tried very hard to create a bunch of low interest, zero interest rate money in order to try and turn things around. But during those environments, low interest rate safe money was not an inferior asset, and so stocks lost half their value or more anyway. And I think we're likely to get to that point. I shouldn't give timing, but I will say that we're seeing a lot more shortfall in the global economy than is widely observed here in the United States, and the likelihood of the United States decoupling from the global economy is not high. That's not to say I'm expecting a recession, right now. But what I would say is that if you start to see the Purchasing Managers Index deteriorate toward 50 or below, if you start seeing the S&P below where it was 6 months earlier, if you see any quick uptick in the unemployment rate, even a few tenths of a percent, all of a sudden, those small things, which individually would mean nothing if you see them in a syndrome, have generally been some of your first indications that the U.S. economy is weakening. And that along with what we already see, which is a very narrow yield curve. You don't have to have an inverted yield curve. You can't get one with zero interest rates on the short end. What you really need to trigger recession warning is just a yield curve that's not particularly steep, and right now we don't have that. And if we were to get those other components of that syndrome, you could say with a reasonable historical level of confidence that recession risks had grown considerably.
Now, to get back to this idea of the market internals and the non-confirmations, I can't turn on CNBC without them trotting out somebody who says, love this market, very bullish here. We have all the right signs. Obviously, a market has people taking both sides of a story. But the headline is that the Dow has hit all-time new records, and did it set another one today here on Friday? Probably. So, but are you,
yes.
The non-confirms, what are you seeing out there in terms of other indexes and sub-indexes and components that aren't confirming right now?
So if you look at small caps were really the first ones to roll over, but you're also seeing, for instance, if you look at the New York Stock Exchange Index, the composite, that's performed relatively weaker. It hasn't confirmed the highs. You certainly see, advanced decline lines struggling. You see a tendency toward, big pickups in new lows. So even though we've been running at new highs and we're at all-time highs, you see these big pickups in new lows on relatively small amounts of weakness, which basically says that, the average stock in the market is actually not participating as much. So there are a whole lot of these things. The other one is really credit spreads, junk spreads, BAA versus AAA, in the Moody's. If you look at the uniformity of the market, not only across stocks, but also across other assets, you're starting to get subtle indications of a shift in risk aversion. And those subtle indications, unfortunately, are sometimes all you get. And, we saw that, for instance, in 1987, where in that particular instance, you saw the subtle breakdowns occurring in utilities and junk bonds and so forth. Corporate bonds, you really didn't see anything else. It looked very strong up until the point where, the bottom kind of fell out. You see generally, for instance, at the 2000 top, we actually had breadth diverging for a long time, and then you started seeing a concert of additional breakdowns, which moved our measures to negative on September 1st of that year, based on the same kind of analysis. And that was really the last hurrah that you saw in the index. That's not to say that we haven't been frustrated for an enormously long time in this cycle, because one of the things that quantitative easing has done that I didn't anticipate is that normally speaking, if you look at bull markets historically, once you've gotten to what we call an extreme syndrome of overvalued, overbought, overbullish conditions, and these are measurable things that we use, once you got to that point, stocks kind of headed south in pretty quick order. And what quantitative easing has really done is it's sustained a very speculative meme a whole lot longer than has occurred in prior cycles. And that's been very frustrating to us. And that's why, we really have focused much more recently on this uniformity as well, because that's one of the things that's always been good to us. It was good to us in 2000, was good to us in 2007 in terms of identifying the break points of those speculative episodes. And the fact that we're starting to see the same breakdowns here is really why we've been, much more, aggressive in using warning words like there are only 3 times where we've used the word crash in the headline of our weekly comments. One was in 2010, but it wasn't a warning. It was more talking about the dynamic of bubble crash, bubble crash, bubble crash. And the other 2 have been in the past month because we are very concerned about the risk of abrupt things happening in this market because we're starting to see that internal deterioration, and that creates some sense that risk aversion is growing. That may reverse, and we kind of, our rule is to take our evidence as it comes. So I may back down on the immediacy of my concerns, but here and now, I would say those concerns are really quite high.
So let's talk about this idea of being in bubbles again, because the Fed famously hews to the idea that you can't see them except in the rearview mirror, but it's obvious that we have a whole lot of speculative froth, however you want to measure that, right? So I have a variety of measures. One is I could look at price of stocks to their sales, and I got a screen after screen of just absolutely monstrous price to sales ratios. Or I could look at price earnings. Like it used to be, you would say, put my filter at a PE of 200. You might get a page or 2, but now I get several pages with PEs over 600. It's just astonishing. I have my own measures, or looking at junk bonds that are yielding 5% in the 5-handle range. All of these things say to me that we're back at that sort of place. Would you agree with that definition, that this is we're in the bubble psychology, the bubble pricing, we're there again?